The line. The broadcast is now starting. All attendees are in listen-only mode.
Hi, can somebody tell me if you can hear me, guys?
Yes, sir, we can hear you.
Okay, great. Yeah, hi everyone. Thanks a lot for joining in today's webinar. This is a topic which is very close to my heart because this is actually this specific topic has helped me a lot as a trader, as an investor. So a brief introduction about myself. I have been trading and investing for almost 20 years now. First, I was trading global commodities in ICE, NYMEX, CME, all of these exchanges. And for the past 7-8 years, I have been primarily into designing of quant strategies for Indian equity markets, right? So I am from ST Advisors. ST is a pioneer in quant investing in India. We started way back in 2008. And uh, about 3 years back, we started Gulaq. And the vision with Gulaq was to help retail investors make better investment decisions. So as of now, we have Gulaq portfolios on HDFC's platform. These are the special premium baskets. You should definitely go and check it out. So about this specific topic of behavioral investing. So as I was telling you guys that this is a topic which is very close to my heart because most of my investing journey I've used in trading and investing, I've used behavioral investing in some shape or form, and that has helped me a lot in overall either reducing risk or generating overall returns, right? So I'm not sure whether my screen is visible.
Sir, your screen is visible, perfectly visible.
Screen is visible. Perfect. Yeah. So let's start. So this is a very famous quote by Warren Buffett in which he says investing is simple, but it's not easy. So what we get from this is actually investing. The rules of investing are pretty simple and there's no secret involved here. But still, we are actually unable to follow those specific rules. And what actually happens is nothing but we ourselves come in way of investing. So we decide because of our emotions, because of our psychology, we decide many things which are actually counterintuitive and which really doesn't help so much in investing journey, right? So this is a study which was done by JP Morgan a couple of months back, and this was very striking. And in fact, I have been seeing these kind of studies in last 10, 15, 20 years, and the result is almost always the same, that an average investor is unable to make even the index returns. So here in last 20 years, S&P has given 9.5%. An average investor has just made 3.6%. So this is even less than a 60-40 portfolio, which is 60% in equity, 40% in debt. And these are index returns, this 60-40 or S&P. To achieve that is really simple. All you have to do is actually nothing, right? You just have to invest in S&P index and forget about it. These returns are very much possible and very much easy, but still an average investor is unable to do even half of this index returns, right? So again, I think this is the impact of emotions. This is the impact of our behavior that we keep uh, that actually influences us to make different kind of decisions, and that is what we are going to talk about in this specific webinar, right? So let me just start with world's first IPO, and in fact, this was also the world's first bubble, right? And this happened way back in 1700. South Sea was a company which was involved in import and export of materials. And what happened was Newton, at that time, he was pretty wealthy man actually, and he started invest. He actually invested in South Sea company and made good profits in very short amount of time. And then finally, when he saw others also getting rich on that same, and he has made some money but not really great money, he actually re-entered this specific stock and with huge amount of money. And actually, after when this bubble burst, and when actually he exited, he had lost about a very good part of his wealth overall, close to $40 million in current dollar terms, right? So the point I'm trying to make here is uh, intelligence is really not enough, and in fact, not so much of intelligence is required, and what is required is that we understand the psychology of ourselves, and we have a right temperament as an investor, right? So in the next few slides, what I'm going to do is I'm going to talk about some of the most famous biases that we encounter as investors, and maybe how to tackle them, right? And please do feel free to keep entering your questions so that I can answer them, right? So let's start. I think one of the first bias I would want to discuss is the overconfidence bias. Now, what happens what is exactly a overconfidence bias and how does it impact us? Let's look. So this was again a famous study done in America where students were asked to rank their driving ability. And actually the results were really striking. The results said that almost 80% of them ranked themselves in the top half, which is actually not possible, right? It can just be 50% who can be above the average mark, but almost 88% felt that they are better drivers than average. And there have been tons of studies in different fields, and in one of this specific study, 90% of the college professors thought they are above average, right? And in another study of almost 8 lakh high school students, only 1% actually thought that their social skills are below average. Now, all of these points, obviously, it's not possible, and it has to be just 50% who can be above and 50% who will be below. But what this tells us is actually we as human beings are overconfident of our abilities, and research has also shown that men are much more prone to this specific overconfidence bias than women. And how it impacts us also, we know that driving with while we are using our cell phone is definitely dangerous. We all know that, but I think many of us actually do get involved in using our cell phones while driving, and this happens just because of overconfidence bias, because we feel it's actually that we are much better drivers than average. So it really does not impact us. That's the feeling that most of us have, and that's why we end up using our cell phones while driving, right? So now let's look at how this overconfidence bias impacts us in investing. Now, one of the very first things is, again, there was a report by SEBI, I think, few months back, in which said that hardly, it's a very small amount that is actually able to make profits, and not only profits, very small number of people are actually of FNO traders are actually even able to get just FD returns, right? It's the number is definitely less than 10%, right? We know that, but still, if you see right now, excuse me, if you see right now, there's so many traders or investors who are actually gravitating towards trading in FNO, thinking it's an easy money or quick money that they can make in FNO, right? This is just because of the overconfidence bias we have in our abilities, right? The second is we trade in individual stocks, and again we know that study after study has concluded that it's a really very hard thing to do, even for professionals, right? Even for, let's say, mutual fund managers, it's a very hard thing to beat index. So why do we think that we as individual retail stock investors would be able to beat index by by some margin? It's almost impossible, if not impossible. Obviously, there are few people, even retail investors, who are able to beat the index, but that number is definitely less than 10%, somewhere maybe around 5-10%, or it could be even lower, right? But most of us are always on the lookout for the next hot stock, the next multi-bagger. We are always talking or doing a research, trying to figure out which is that next stock that is going to become the next HDFC or Infosys, right? The third is we try to time the markets, and again there have been so many studies that it's a very difficult thing to do, and these are actually the things we are talking about, which has actually resulted in an average investor even unable to make the index returns, right? And finally, the impact of overconfidence bias is also that we under diversify, thinking that we know what all are the risks involved in the things or in the asset classes that we are investing, and we actually tend to under diversify, which again hurts us in the long run. So these are the impact of overconfidence that we have in our abilities specific to investing. Now let's move on to the second bias that I wanted to discuss, that is the prospect theory. Now, what is a prospect theory? Prospect theory actually tells us how we actually behave to profits and losses in a different way. Now, we know in this specific image, what is shown is obviously, let's say if we get $100 from somewhere, we feel very happy. But if we get $200 and then we lose 100, then again we are ending up with 100, but we are somehow miserable in this specific case. So that's what prospect theory tells us, that we actually react to profit and losses in a different way, and we're going to see how this impacts our decision making, right? So let's say there's a problem one in which you have to choose between option A and option B. So option A is get $900 for sure, and the option B is there's a 90% chance to get $1,000. So on average, both of these things are same, right? 90% of 1,000 is 900. So which is the option that people would choose? So can you guys who are attending this webinar, can you please answer in the chat box whether it's option A or B? Okay. I'm unable to see. Okay, I can't.
You can just click on the question box. There will be the answers. So most of the people are saying A. Hello, Vivek sir. Hello, Vivek sir.
Anything. Whereas in problem two, most of the people are actually trying to risk in order to avoid a loss, right? And even though that chance of avoiding loss is no matter how small it, we actually end up taking much bigger risk, right? So certain things that we can infer from this is we prefer certainty over a gamble when it comes to gains, right? In problem two, the thought of losing $1,000 is actually not too much different in our mind than losing $100, right? So in that case, we actually are taking a much bigger risk if it comes to losses. Whereas in case of profits, we don't like to lose a sure bet, even though that sure bet is maybe not the best option, right? So how does this translate to investing? And this is again a very, very common phenomena in investors, that what happens is when it comes to our profits, we try to book them as soon as possible. It's very, very hard for us to hold on to our winners, right? We try to book that profit lest it just goes away, right? So we are risk averse with our gains and we want to cash out our winners, whereas we are averse to losses. So we resist realizing or booking our losses. And that's why in all our portfolios, we would have few stocks which we have bought few years back and which are in losses, but we are still waiting that when it comes to our buying price, that is the time I'll exit and I'm not booking those losses. So again, what is happening is I'm trying in second option here when we are dealing with these losers, that time we are actually taking much bigger risk than normally what we would actually like to take, right? So we are risk seeking when it comes to losses. We hold on to our losses, risking losing more money in order to turn it to a winner, right? And we all know what to do now that we are aware of prospect theory and how it plays out in our mind. We know that actually this is just the opposite that we should do, that if we have a losing trade, we should try to close it as soon as possible and let our winners run, or even in fact invest more if these are actually if you are actually confident, right? Next is a bias which is named as representativeness bias, right? So what exactly it is and how it impacts our investing, let's go through that now. Okay, we have all heard this quote, judging a book by its cover, right? This is an old saying, but it's a lesson in representativeness bias. What happens is, just by looking at cover of a book, we like to believe that that book is of a specific genre, whereas when we actually read it, it becomes, or it turns out to be something totally different, right? And just because of that cover, we thought it to be really something else. So how does this representative bias plays our mind in investing? So again, this specific bias is a kind of a mental shortcut that we use when we are trying to judge a specific situation or probabilities. So similarity of objects is confused with the probability of an outcome, right? Now, how does this impact our bias in investing? One of the very common things is we tend to invest in the companies that we feel have phenomenal products. So let's say Apple, Netflix, Hindustan Lever, all of these companies, obviously they have given good returns, but not all great companies are great investments, right? Great companies are only great investments if the price is right. And many a times what happens is, the way it turns out is because these are great companies and everyone is rushing to invest in this, it's very, very hard to get actually a very good price to enter into these companies, right? And many times actually we end up overpaying for these great companies, which in turn then they don't turn out to be great investments because of the price we have paid to enter. So again, great companies might not be great investments. They generally are, but not always. And same ways, average companies could turn out to be great investments if you actually enter at a great price, right? So great companies, not necessarily great investments. And this is actually happens because of the representative bias that we have in investing. Guys, again, I would urge you, if you have any specific questions, do keep do post it out there in chat and I'll be happy to answer. Okay.
Vivek sir, sorry to interrupt you.
Yeah.
Sir, you are able to see the question box?
Okay, I was looking at the chat. Yeah, I can see. Yeah, I can open the question box, but I can't see any questions as of now.
Okay. No issues, sir. You can.
Yeah, I can see one. I can see one comment in the question, but that's about it.
So just click on that.
Okay.
There will be one pop-up option, so it will come up.
Okay. Yeah. See, I can see, but it's. I can just see one line by line only. I'm unable to see all the questions actually. Yeah, this is a problem here. I can't. Let me try to. Okay. Yeah. Now I am able to. Okay. People have actually answered in the earlier options. I was looking at the chat box, but yeah, good to see that.
No issue, sir. You can continue if
Okay,
any
great.
question is
So
there.
yeah. Yeah, thank you. Yeah. So next I'd like to talk about Gamblers Fallacy. Now, what happens in Gamblers Fallacy? Let's have a look at it and how it impacts us. So this specific game of roulette, in which what happens is you're betting on colors. So there are equal red colors in these numbers and equal black colors. And there's a one green zero. So the probability of getting a red or a black is almost close to 50% each, right? Slightly lower than 50%, but for this purpose, we can just assume maybe it's 50%. So what happened in Monte Carlo in a casino in 1913 was there was a string of blacks, actually 5 or 6 blacks which came consecutively, and people started actually betting that now the red is likely to come, right? So they kept on betting and betting, and actually what happened is there was a series of 26 blacks, and only after that actually a red came. But what happened is, because of this being a very long series, people kept on betting big time on this. So after maybe 10, 15, 20, they were betting very big amounts, and because they were not getting that specific black, they were just losing that money. And on that day, the uh, the players in this roulette game, they actually lost very big amount in that game. And this actually happened because of this Gamblers Fallacy, which is also known as Monte Carlo bias. So let's say you toss a coin. Now there's obviously 50-50 chance of getting either heads or a tail. But if you toss a coin once, and if you get a head, it's not necessary that in the second you'll get a tail, right? Because this probability actually works over very long term, and over 5, 10, 15, or even 50 uh, coin tosses, it's not sure that you will actually get to a 50% probability, right? So what is actually happening is we are believing that short-term odds represent the long-term counterparts, right? And we believe that certain random events are less or more likely uh, to have impact based on the outcome of previous events, right? So this is a gambler's fallacy, and how this impacts us is uh, in we it would have happened many times that a stock is falling, let's say Paytm or any other stock, it's falling, and then we think, yeah, itna 50% गिर गया अब कितना गिरेगा, right? We get into that kind of and that kind of mindset that actually it can just keep on falling, or even when it is rising, and people who are trading in FNO, they'll think that, oh, it has risen so much, now it should correct, let me take a short position. Now that specific, this is actually happening because of the emotions. If this is you are going long or short based on certain approach that you have decided you will follow, then it's fine. So the decision making should not be based on emotions, rather it should be on a systematic approach, right? So how do we avoid it? We need to recognize the independence of these events. So yesterday, if the stock has risen, it's not, it really does not tell too much about what is going to happen today, right? So you have to think through the actual process by which that event is occurring, and only then that will help us actually make that decision in an objective way, right? It might also be helpful to think about why you think these past events have had some bearing on the future one. Okay. Now let's move on to the next, which is again very popular, and almost all of us would have gone through this, which is known as the herd mentality, right? Now we all understand herd mentality. We keep on doing it, and now let's go through what are the causes of these herd mentality, right? The causes are a deep desire to be accepted in a group or in a community, or a strong sense of to live in conformity with social standards, right? Individuals also follow crowd because they assume that others know much more than they themselves know, right? Or finally, the fear of being alone, We really don't like to be alone. We don't like to be missed out or left behind, right? So, so this bias actually comes from the idea that following the crowd will lead to desired outcomes, as there is safety in numbers, right? So this is why it actually happens, and there are very many examples of this, and this happens in almost all walks of life, be it voting, be it riots, sporting events, or be it general strikes, religious gathering, or and especially in investing. And we all know how it happens in investing. We have seen these booms or bubbles that happen in stock market, or the crashes, and the reason is just the herd mentality. We have seen the tech boom. Any company which has a .com, and no matter what the business model of that company is, if the company's name is actually having a .com, people are just going to fall over each other to buy that specific stock, right? Same thing happened with real estate in 2008, when people of very limited means were actually buying multiple houses, taking on big amount of loans, thinking that the house price is always going to go up, right? And that resulted in the mortgage crisis in US, which has actually impacted the stock markets world over. It fell almost 50%, right? But then the herd mentality, if you keep that in mind, you at times maybe can take advantage of it also. And this happened just 2 years back with a company named GameStop, and retail traders uh, actually contributed to it. Everyone was about key. This is a trade. Everyone knew this specific company is not that good, but the whole idea was, because this is a herd mentality, everyone was actually buying it. So the trade was actually that you would buy it, and few days down the line, you would want to sell it, because you knew that people are going to come and keep on buying it. But actually, a lot of people made money in this, but actually when it crashed, more people actually lost much bigger amounts of money in this, right? Now let's move on to the next bias, which is self-serving bias. And what this states it is, you can see in the image, that if we have good result, then we attribute it to our abilities, we take credit of it. Whereas if the result is bad, we try to blame it on others. This happens almost everywhere. And how this impacts us is, if we are actually not attributing our failures to ourselves, to our own mistakes, then obviously we are not taking ownership of it. And what that means is, we are actually we won't be able to learn from those mistakes, and which means that we'll again keep on making similar kind of mistakes, right? And and we all know that very important component of becoming successful is going through those failures and learning from those failures. But if you are actually not taking ownership of those specific failures, then you are not likely to learn from it. And how does this impact us in investing? So as investors, we are always spoke about this in the overconfidence bias also. Because of our overconfidence, whenever we are selecting a stock or making a trade, when the results are good, we are attributing it to ourselves, that I did a good job. I did a good job in trying to figuring out this specific stock, or using my technical analysis or fundamental analysis, or this research that I've done, I was able to figure out this very good stock and made money. But if actually that specific trade turns out to be a loser, in that case, what happens is, we'll try to make excuses that maybe my friend gave me wrong advice, or the company's management was not doing their job well, or the current market sentiments are not that conducive, right? So we are not taking ownership of those specific trades, and only taking ownership of the good trades, right? And I've already spoken about how this will impact us, as we'll be not learning from our mistakes. If we are not learning, then we are unable to grow, and we'll keep on repeating similar kind of mistakes time and again. Okay, let me just quickly go through if we have any questions. Okay, nothing as of now. Okay, so yeah, Now I'd like to move on to the next bias, which is the recency bias. So what is happening in recency bias is, in this specific image, I've shown that I'm considering, let's say, a mutual fund, a stock, or any PMS, anything in which the longer term returns are phenomenal, but the short term returns haven't been really that good. It has been lower than average. And then we are trying to decide. And what is actually happening is, excuse me, what we are trying to decide. And what happens in this case is we overemphasize on the shorter term, on the more recent results, and we actually try to ignore the longer term behavior of that specific stock or mutual fund, right? So we are giving more importance to recent news. We extrapolate short term returns to long term returns, and this is something that is happening a lot these days. What is happening is, because the stock market has given phenomenal returns in last 2-3 years from the COVID lows, and many people entered during that time, they are now sitting on very handsome gains. And two things are happening. One is the recency bias. One is either we are becoming too overconfident of our abilities that have been able to achieve something, whether actually it's the case of markets that has given very good returns, right? And we are extrapolating these kind of returns. So let's say I invested in a fund which gave 50% returns in last few years on an average, and my expectation is it will keep on giving me 50% returns, whereas in stock markets we know that over long run 50% returns is definitely not possible, right? For any fund to make that kind of returns, there would hardly be any fund, if at all there is any fund, right? So what is happening is we are either extrapolating the short-term returns into the future, or the second bias that is happening is, we talked about initially the prospect theory, in which we are trying to book profits right now. We are thinking that there's enough returns I have made now, and I want to book profits. Now, both of these things are not fine. The decision has to be in a proper systematic manner. Only then it will be right decision. If it is happening because of emotions, there's a very good chance that that is going to turn out to be a wrong decision. Now, this is obviously these biases are very difficult to counteract, because this plays on our human emotions of fear and greed, which are very powerful emotions, right? Okay, so what can we do to correct these behavioral biases? Now, we have spoken about 7 most popular behavioral biases which impacts us as investors. So first of all, we need to understand that these are not easy to correct. Our brains are actually hardwired to react like this because of the thousands and hundreds of years what has happened to us. And that is why human brains are actually hardwired to act like this. So first point we have got to understand is, these are definitely not easy to correct. But at the same time, if you are aware of these biases, that's a very good starting point. If you are just aware that these are the common, out of, let's say, these 7, these are the 2, 3, 4 most frequent mistakes that I make in my decision making, whether it is in investing or in general in life, that awareness in itself is a huge edge, or a very good starting point, actually, right? Next is, we have to try to make things much more systematic in nature, so that the decisions that we are making, we are not using too much of emotions in this, and these are more or less systematic in nature. Obviously, there is going to be changes in that specific system. You have to keep on making that system better, but more or less, if you have a specific system in place, be it with investing or any other thing, the way you decide things instead of emotions, a proper well thought out system, that is going to work much better than anything else, right? And I think finally, what it has helped me personally a lot is meditation. So because of the meditation I have been able to do, I feel that I am much more aware of my decisions, of the reason why I'm making those decisions, of what I'm thinking currently, why I'm thinking that. and that in itself has made me a much better investor. So I think meditation is definitely one of the top skills, one of the top capabilities that has helped me become a much better investor. Right. I'm at the end of this webinar. These are the disclaimers. Whatever we have spoken about, this was nothing related to nothing. It was definitely not a market advice. It was just for education purposes. And the details of ST advisors, we are a SEBI registered investment advisor, and the details are given on this specific slide. Yeah, I'm happy to take on any questions regarding what we have spoken today about these behavioral biases. If anyone wants to share their own experience or they want to know more about Gulaq car products, I'm happy to take questions from the audience. Yeah, I think people are asking about this PPT. I think the easiest way would be that this would be on HDFC's YouTube channel. So we can just go there and have a look at all the PPT once again. Yeah. Okay, I can't see any more questions. Omkar, if you're there and if you can see more questions, please do let me know. Yeah.
Yes, sir. So, dear customer, we are open up for question answer. So, if you have any questions, you can ask in the
Okay.
chat box as well as question box. Sir, Munish Chauhan is asking what kind of psychology is required while selling stocks or making profit?
While selling stocks.
Yes, sir.
Okay. See, while selling stocks, what we have spoken about is in the prospect theory. One is we should be aware that we tend to sell stocks in a we are more eager to sell stocks actually, right? And that is something that we all would actually have to avoid, right? Even right now, what is happening is in mid caps and large caps, uh, people are saying that there's a overvaluation there and they're booking their profits, right? I don't think that is the right strategy because we as investors are not very good timers of the market. So I can definitely share what I personally follow. So I personally, what I follow is it is definitely not dependent on market valuation as much as my needs. So if my needs are say 3 years down the line, then I want to keep that much of money in mostly into debt and maybe a little bit into equities, but maybe about 70 to 80% in debt and 20 to 30% in equities, and that's it. Otherwise, if I don't need any capital in the next 3 years, then I personally am never thinking about exiting a stock or exiting my investments in equity markets. So it's totally dependent on my needs and not specifically on markets valuation as much. Okay, because that's what we have seen, that we are not very good at timing the market, and that is why most of my investments are for the long run, and that's why I don't worry too much about day-to-day news, what is happening in the market, because I'm investing for the much more longer term and not for few 100 points here or there. Yeah. So again, the answer is depending on your needs, you should plan your exits and not so much on dependent on your market's valuation. Yeah, I can see a few questions. What would you have done if Delta Corp is in your portfolio? Yeah, Delta Corp, I think it had a very severe negative news. In this specific case, see, personally, I don't like to bet on individual stocks. I never do. Very, very rarely I do this. So I never invest in individual stocks. Almost all of my investments are in three areas. One is ETFs, mutual funds, and Gulaq small case portfolio. So I don't personally take these individual stock calls, but let's say this Delta Corp was in the portfolio, Gulaq portfolio. In that case, we definitely, this depends on case by case basis, and in this case, because this was a big negative news out there, and it is kind of a rare kind of an event, then definitely I would want to get out of that specific stock. Yeah. Yeah. I think, yeah, I can see the questions now. So one of the question is, I have invested 2 lakhs in Gulaq Gear 6 right now and planning to invest 10 more lakhs in this. My question is in you quantitative. Okay, this is, I can't make out this question. How do you decide the right price for great companies? Now again, specifically, see, what I have always followed is a quantitative or a systematic approach to this, and what we have made in Gulaq is a multi-factor based strategy. So this decision is not based on one specific factor. It is not based on, let's say, only results, or only having some great fundamentals, or only having, let's say, very good technicals, right? So it's a mix of all of these things actually. So in Gulaq, we have more than 100 factors based on which we are deciding which are the great companies. And again, obviously, depending on the current market situation and their price, whether it makes sense to buy this specific company right now or not. That is how it is decided. Again, this process is not manual. This process is very much automated, and we have huge amounts of data which computers are able to churn to make sense of that. So again, this is, as a human, for me, it is not possible to decide or not possible to digest that amount of data. And that's why I don't do it personally. I leave it to the algorithms, the Gulaq and ST algorithms that we have developed. And that is how we decide on based on that multi-factor approach, we decide whether it's a good company to get into right now or not. Right. One of the questions is how to practice stop loss, waiting more time when in loss rather in profit. Again, I think this is more a problem about execution rather than actually deciding what should be a stop loss, right? We all know what to do, right? So let's say, and this is dependent on your strategy also. Let's say if somebody is trading, although this session is not for trading, but these biases do impact traders also. So let me answer it from that perspective, because as investor, I frankly do not have any stop loss because I'm trading or investing for the long term, right? But as a trader, if somebody is trading, then definitely one should have a specific stop loss, and it depends on your strategy. So broadly, there are two kinds of strategies in trading. One is the momentum strategy and another is the mean reverting. So in mean reverting, what happens is if the market is going up, you'd say that it should revert, and I have a system in place that it has gone up by so much, and then I'll short, right? So that is mean reverting. Whereas in momentum strategy, what happens is if it is going up, you will buy, right? So these are kind of opposite strategies, but Stop loss depends on whether the strategy is mean reverting or momentum. In momentum, it's very important to have a stop loss and have a very tight stop loss, because you will tend to lose a lot. There'll be much higher number of losers, but when you make in one trade, you're going to make much more. So your stop loss has to be proportional. Stop loss has to be very small, and you'll keep on making multiple losses. You have to be ready for that. And eventually, when you are making profit, you'll make a big profit. So you should have a tight stop loss. Whereas if your strategy is more of a mean reverting strategy, in that case, actually, tight stop losses are going to hurt you a lot. So in that case, you should have, frankly, very wide stop loss, so that they are very rarely hit, and most of the times you will keep on making profit. But in that specific strategy, once in a while you will lose money, which is very less in frequency, but those losses will be uh, on the bigger side, the extent of those losses. So it depends on your strategy, what's the kind of strategy you have. But as an investor, I really don't believe in stop loss as such. Yeah. So I think there are some stock specific questions, and frankly, I'm not the right person because I don't judge individual stocks. I practice quantitative investing through Gulaq portfolios, and I almost never invest in individual companies on my own. I just leave it to the algorithms because they are the ones who are able to identify and do a much better job of investing rather than myself. Right. So there is a question about Gulaq Gear 6. I have invested. Uh, would you recommend to put all my 10 lakhs right now in Gulaq Gear 6, or half of it I should put now and rest 5 lakhs after Diwali when market falls? Again, I don't know if the market is going to fall after Diwali or not, right? I don't take short-term calls. This is very difficult job to do. Now, how much to invest in Gulaq Gear 6? I would say do not in not only in Gulaq Gear 6, but in any fund, do not invest more than 20 to 30% of your overall portfolio. That's the broad range you should have. Don't go over it. So if you in total, if you're having 10 lakhs, I would say don't invest maybe more than 3 lakhs in Gulaq Gear 6. But if you have 10 lakhs to invest in, if your portfolio is much bigger and if you want to invest 10 lakhs in Gulaq Gear 6, uh, I would say don't wait for market fall. If you feel right now is not the best time to enter, have a systematic approach. Do a SIP, and maybe over next 6, 8, or 12 weeks, invest everything in markets in Gulaq Gear 6. So have a systematic approach and do not leave it to markets. Just some time back, I was talking to in fact, today morning, I was talking to an investor who was actually has been waiting for investing a big part in Gulaq Gear 6 for almost last 1 year. And we know that Gulaq Gear 6 has done really well in last for 1 year, and he has missed out on almost all of those gains. He invested a small part, but has been waiting for a good correction in markets in last 1 year, and he hasn't seen it. So he's just sitting out of market. So that is not the best approach actually. Yeah, I think more or less I've covered. As a new investor, does it make sense to start with small case investments like Gulaq Gear 6? This is by Uday Vartak. So Uday, personally, most of the times what I suggest is to start with index funds. These are much safer options. You tend to learn. You tend to learn about markets, about investing, about yourselves, and only then decide whether investments in Gulaq Gear 6 portfolios like this is meant for you. That is my advice. But then there are investors who have read and learned a lot, and there are definitely very good resources available online. And if you think you have again learned a lot, uh, have learned a lot about markets, and if you're ready, then I would advise you. Then maybe you can start. But again, in that case, as I've just said some time back, uh, don't invest more than 20 to 30% in Gulaq Gear 6, right? That will be my suggestion. Okay. I think more or less I'm done with all the questions.
Yes, sir. I think
Great.
we should
Yeah.
conclude this call now.
Okay, great. Thanks. I think it's almost 7 now. Yeah. So thanks a lot, everyone. Thank you for taking out time. I hope this was of some value to you guys. Again, thanks a lot. See you.